The market moves in mysterious ways. That's our topic for this morning's Backstage Pass. Stocks and mortgage bonds are lower so far this morning, and they're lower sharply. And unlike yesterday, there's a pretty slim chance of recovery for them so far today. We'll see what happens. But if you remember yesterday, stocks and mortgage bonds opened up sharply lower yesterday, and then mortgage bonds came back up and then went into positive territory after that hotter reading from the CPI report that came out. Today, it doesn't look like that's going to happen. The 10-year yield pushed above a technical ceiling of resistance, and it kind of got a little bit of momentum when it did that. Mortgage bonds followed with some selling and going in kind of a weaker direction. So right now we have mortgage bonds down at about 42 basis points at the time of recording. 10-year yield is up about 9 basis points at the time of recording. And what this means for mortgage rates, the mortgage rates are going to open up worse today. And the lenders that opened early, because some of this movement happened after markets opened, so the lenders that opened up early with their rate sheets, probably going to be repricing for the worse if they haven't done so already. Now, some of this movement that is happening in the bond market is coincided with something that normally, you would think maybe the CPI data, something like that. But what happened is that there was some momentum and movement in the mid-2023 Fed funds futures, and that movement was to the weaker side of where it was yesterday after the hotter reading from CPI. So the movement in the bond market happened after that Fed funds futures market movement. And what that means is that the markets are reacting to what they think the Fed is going to do in the future, not just this coming month's meeting, but also into next year. And so that's kind of what the market is reacting to. Also, PPI, which is Producer Price Index, that's the inflation measure at the wholesale level, that came out today, and that data came in hotter than what was expected. 1.1% month over month, which is hotter than the 0.8%, and the year over year was hotter as well. So the PPI data that's hotter, the CPI data, Consumer Price Index yesterday that was hotter, and then we got this reaction in the Fed funds futures market. All those things are putting pressure on the mortgage bonds, and that's why we're seeing mortgage bonds do what they are doing today. Now, in other news, Mortgage Bankers Association released their weekly application data from last week. They released this data yesterday, and it showed that purchases were down week over week by 3.6%, and they're down year over year by 18%. The average interest rate last week was 5.74%, with paying about a point. That was unchanged week over week. Refinances increased about 2%, but they're down 80% year over year, and they make up about 31% of all transactions right now. All right, so that's all the news that we have for today. Remember to like, comment, and subscribe. When you do subscribe, make sure you hit the bell icon. That way you get notified as soon as we post this update, and you can get this information as early as possible every day. All right, stay positive. Have a great day. We will see you tomorrow.